Welcome to video number 4, the complete plan. In the previous 3 videos, I explained to you why the bulletproof bookkeeping process, and specifically the e-commerce accounting workflow, are critically important to compiling a set of books that can hold up under any kind of scrutiny. I explained that this is important not just for the obvious reasons of possibly wanting loans or investments, but also so that you and or your client have extreme confidence in the information that you can get out of the books, in other words, the reports. These reports are super important because, especially in the world of e-commerce, you need good, detailed, reliable information fast so that you can keep up with, or better yet, stay ahead of the competition. So far, we've taken a really good look at your revenue cycle, and specifically how the money flows from the gross sale to the net amount received in the bank and everything that happens in between. To see the entire picture, you need to understand the other side of the sales cycle, which is your inventory turnover. Right? As you sell your products, you turn over your inventory, and that cost flows from the inventory asset into cost of goods sold on your profit and loss, which, as I've explained previously, is how you arrive at your gross profit on anything that you've sold. And with e-commerce, because the competition can be so stiff, one of the most important factors around how you succeed is based on customer satisfaction. With e-commerce, one of the most important factors surrounding customer satisfaction, apart from the quality of the products itself, is being able to ship your products to your customer really fast. The reason Amazon is winning in so many ways is based on how quickly they can get products shipped to their customer. In fact, I was recently on Amazon looking to buy something, and I have an extension called Capital One Shopping, which helps look around the internet to see if the product I'm looking at can be found for less money elsewhere. And as I was recently looking to buy something, I got that prompt from Capital One Shopping that said, hey, you can save about $35 if you get this over here on this other site. So I clicked over and checked it out, and the difference was, instead of getting the product shipped to me within a day or two, I was going to have to wait like over a week. And I said to myself, for $35, it's not worth it to me to have to wait a whole week to get the product. And this is really important from the merchant standpoint to understand. People want what they want, and they want it quickly. And what this all points to is how critically important inventory management is. And the only way to manage your inventory effectively is to have really good, real-time, accurate, reliable information around your inventory numbers. And that means the accounting. The worst thing you can do is run out of stock in an item that sells really well. Your customers will instantly click around and look somewhere else to get that product. They're not going to wait. With that in mind, here are 5 important benefits to really good inventory analysis. Reduce stockouts and project delays, improve cash flow, delight customers, reduce inventory waste, and finally, better pricing from suppliers and vendors. I will dig very deep into all of this in the course, but for now, as long as you understand how important it is to have good inventory management in your process, let's jump over to my QuickBooks Online company so I can show you the basic layout of how to manage inventory in QuickBooks Online. To illustrate this, I'm going to actually take you into a product that's already got some purchases and sales recorded, because as you'll see, this really makes it clear how everything flows. So I'm going to go to Sales here, Products and Services, and then we're going to scroll down to this item, my watch, my top selling watch, and we're going to run a report. Okay, then I'll run it for all of time, so I don't have to worry about the dates here. And here it is, and this makes it look really clear, okay? So first of all, make sure we're clear on what we're looking at. We've got inventory asset. Over here, we've got the watch sales, which is the income. And then over here, we've got cost of goods sold. So when I run this report on this particular inventory item, it gives me the breakdown of the activity in all the areas that the movement of that inventory impacts. So again, there's the inventory asset, where it goes when I buy it. There is the income account, what gets recorded when I've sold it, the amount of money I sold it for, and then the cost of goods sold account, which is where the inventory transfers from the asset to cost of goods sold once that item has in fact been sold. So if you look at this, if you follow through what we're seeing on this report, it becomes really crystal clear. So we had starting inventory value of 0. Then we purchased 100 units at $35 a piece for a total of $3,500. Okay. And then we have a sale, right? So we sold one of them for at a cost of $35. So this is in the inventory asset account. So what we're looking at here is at cost. Okay, so we subtract 1 from inventory at cost is $35. On the sales side, we sold one of them. Now it shows as a negative quantity in the sales because we're still reducing our inventory quantity as we make that sale. Okay, so we sold one for $150. This is what's hitting our income account, our watch sales account. And then finally, our cost of goods sold, we're effectively increasing cost of goods sold based on 1 unit. So this unit that we've sold, that's here, and this is really the same unit being sold here, this transfers out of the inventory asset and into cost of goods sold, and we now increase cost of goods sold by that same $35. So we sold the watch for $150, and our cost on that watch was $35, right? So you do the math, we made $125 on the sale of that watch. Pretty good profit margin, by the way. While inventory management can get infinitely more complex than what you've just seen here, this is the basic flow of inventory. So you might have a product that you buy, and then you sell it for something more than what you paid for it, and that's what we've just seen here in the example. Or maybe you buy a few different raw materials, and then assemble them to create a finished product, and then you sell that finished product. And hopefully you sell it for more than the cost of those raw materials that you bought. And of course, hopefully there's also enough profit in there to cover all of your other overhead and costs relating to selling that item. Right? And then, of course, as we sell volume, as we sell many units of whatever it is that we sell, we're hoping that the gross profits generated from those sales is more than enough to cover our overhead, which is like everything else that happens on the profit and loss statement. That's the basic model of an e-commerce company, right? We buy it at one price, we sell it for a higher price, and hopefully we cover all of our costs and then some, because obviously the name of the game here at the end of the day is to generate a profit. So the only way you're going to know if you're truly profitable is if you have really good accounting data. For a lot of businesses, it's really easy to see if they're profitable just by watching their cash flow. You can clearly see that the bank account balances are accumulating and so on and so forth. With e-commerce, it tends to not be so straightforward. I've worked with a lot of companies over the years where one of the reasons they came to me was they really couldn't tell for sure if they were profitable. They didn't know for sure if the right cost of goods sold were lining up with the sales in the period that they were made, right? So it takes very good accounting data to get the insights you need to be certain about whether or not you're truly profitable in an e-commerce company. In reality, especially if you're the kind of e-commerce company that sells a lot of different products, you need very good and detailed analysis of all of your different products to see which ones are profitable. You might even need to analyze by sales channel, right? Some products might sell better on one sales channel than another. So you're going to need to have very good, accurate, reliable, detailed data that gives you the insight so that at some point you know when it's time to cut a product out of the mix and when it's time to maybe bring some new products into the mix. And then again, as I've mentioned, we have the inventory management piece, which is very important because if you overstock your inventory, that can cause you to lose money. If you understock, you can lose sales, which also really means losing money. And that, my friends, is the complete plan for how to compile bulletproof books using the e-commerce accounting workflow coupled with inventory management. This is how you get really ridiculously accurate books so that you or your client have the data that they need in the form of the reports that you can pull out of the system so they can make important decisions about where to go with that company. In the next video, I'm actually going to have you look at a couple of case studies. These are actual clients of mine. One is the guy who you've heard me reference so far in the course a couple of times, he's the one who got me into e-commerce accounting in the first place. The other one is a client who is currently a client. As of this recording, she was recently on Shark Tank, and I had her on a Zoom shortly after her episode on Shark Tank aired, and I think you'll find it really interesting, some of the comments she has that she made about, of course, the importance of having her numbers ready to go on the show Shark Tank and how important it was that she had this level of confidence that I'm talking about by the time she got onto that show. She had to know her stuff and know it really, really well. So I hope you enjoyed this video, and stay tuned for the next video coming soon to an inbox near you.